Alan Brochstein joins me now. He's the CEO of New Cannabis Ventures and 420 Investor. Alan, welcome back.
Hey, it's great to be here. It's been a while.
It has been a while. And since we last chatted, the market has lost, call it 50% of its value, though some might argue that that is a healthy correction. How do you view this whole revaluation to the downside?
Yeah, well, disappointing. I don't want to know if I call it healthy. That's what a lot of people would say because they have nothing else to say. But it's very disappointing. And, this has been a really rough 3 months. And it really started with CanTrust,
right,
which became Can't Trust. And
right.
Bruce Linton getting fired and all these delays with the Department of Justice and now the vaping problems and the capital markets seizing. And I will say that I've been following the space for 6.5 years, and it's pretty par for the course. I just wish I had anticipated it a little bit better. When we ran up in Q1, I warned my subscribers not to extrapolate. We weren't going to keep going up 50% per quarter, but I really am kind of surprised to see the market make 3-year lows, which hopefully are in. I went on the record, James, and said not even a couple weeks ago, about 10 days ago, that we were within 10% of the low in 2 weeks. I kind of put a time and price on it. We already took out the 10%, so that's all right. But hopefully I get the 2 weeks part right. Monday may have been the low.
Sure. Yeah. Well, that's intriguing. I would concur with you. If for no other reason, then I think all the companies that have had to eat humble pie as a result of faulty guidance have done so. And now we're starting to see some positive results with the Aphria, although another...
I don't think so.
No, you don't think so? Okay, so let's talk about Aphria. Aphria reported 120 some odd million in revenue. I think it was like 70% of which was from distribution revenue. In an unrelated business, it would seem that there was no explanation in the notes about the margin or anything. So what was your take on that?
So my take was, it's just funny. The glass is half full or glass is half empty. And Hexo made the mistake of telling people their revenues would double. And they've pre-announced, they haven't announced yet, but their Q4 ended July 31st. This was Aphria's Q1, August 31st, so 2 months of overlap there. Hexo grew about the same rate as Aphria. Hexo's stock got pummeled. So what Aphria did right was they reiterated their guidance. Now, you can read some of the reports out there. There are analysts out there scratching their heads. In particular, there's an argument about how are they going to go to 40% market share from their current 8% in retail. That's kind of the scary thing to think about. But they were able to, quote unquote, report a profit. Well, what is their source of profit? Is their cannabis operations? No. Is it their distribution operations? No. It's their stock price went down. And how does that work? They have a convertible note. When your stock price goes down, there's an accounting gain. So that was part of it. They also had a gain related to their holdings in publicly traded Althea, which is a licensed producer in Australia. So that was their profit. They actually used, I think, 30 million of cash. I calculated if you strip out their biological assets, they lost about 13 or 14 million dollars, which was an improvement. So I don't want to say Aphria was terrible. It was kind of similar to Hexo. It's just that people weren't expecting a double like they were from Hexo, because Aphria had a really strong quarter the prior quarter. And I'd say also, it remains to be seen, but Aphria reiterated their guidance that some analysts think is insane. So,
right. So that $1 billion run rate by the end of calendar 2020, a bold statement. And we looked at it after the fact. I had Irwin in for an interview. Unfortunately, I had him in for the interview before I had a chance to read the financials, so I didn't get to ask him any pointed, tough questions specific to the actual line items, which I regret. But the bottom line is, I guess, if they can make money through distributing conventional pharmaceuticals in Germany, and they can continue to show profit through the deployment of the use of biological assets in its most optimistic form, which is, which is a fundamental flaw to me in the IFRS system, and I don't really understand how it continues to be sort of not fine-tuned, but then arguably they could continue to report. I mean, all they have to do is double the thus creatively arrived at revenue in a year, and that should be doable.
Well, I feel like I'm pretty negative on Afria, or I sound it, and I'm a little bit cautious, so don't get me wrong, but I do want to say a couple of things positive. Number one, they like to talk about their cash position, and their cash is not unencumbered, but they do have good liquidity. They have that convertible note, which is really dead at this point. The stock price has come down so much, but so they're not in as bad a shape as some others. So I guess that's a good thing. So they're able to weather the storm. That's one good thing I can say. The second good thing I'll say, so Afria has been, accused for a long time of not having very high quality cannabis, and I can't confirm or deny it, but I did see something interesting yesterday. Unfortunately, it came from one of their bullish analysts, but still, the analyst reported kind of hearsay, but from a reliable source. I think someone at the Ontario Cannabis Store, but somebody in the system that said that their quality has really improved. And I will say, if that is true, then Afria has a good chance of creating value over the long term. Remember, they got just destroyed last year, that short report, and spending all that money, transferring the wealth to other companies,
right,
as they gave all those shares away and for their LATAM acquisition in Nuvera. So,
right.
Now the stock, it doesn't look expensive, I would say, but they need to execute. And I don't think 8% sequential growth is something that excites me. I would suggest everybody take a look at what's going on in the United States. That's where things are exciting in terms of revenue growth.
Sure. So, okay, let's shift to the United States now. One of the companies that continues to perplex me is Harvest Health and Recreation, which, by some measure is potentially the largest vertically integrated LP in the United States, multi-state operator, sorry, not LP. But they have been beat up and taken to task at an egregiously more higher degree than others. And I'm wondering, is that all related to the Department of Justice scrutiny of the 3 acquisitions, or is there something else that I'm missing there?
I think there's a lot. And I have to say, I had high hopes for Harvest, and I do wish them the best, don't get me wrong. I had to after that last report, I said, see you later. This is a company that's really changed, and I'm not a believer that leopards should change is it spots that leopards have? Tigers and stripes. So right. Leopards changing their spots. And so what these guys were excellent at doing was winning licenses. And even that came into question this year. They got in trouble in Pennsylvania. They got in trouble in Ohio. So these things kind of put a question over that part of their business. But also, all of a sudden, they became M&A experts. And they did a deal in California, a deal in Pennsylvania, I think. Yeah. And then, obviously, the big deal, Verano. And that got hung up. But I think investors should say, do these guys have the chops to integrate? And they would have told you, oh, yeah, don't worry, we have Steve Gutterman. No, they don't. They issued a Friday night press release a couple weeks ago. It came out at, I think, 9:20 Eastern time on a Friday night, which is never a smart thing if you're a company. That is a red flag right there.
Sure,
Any company putting out a press release about a senior executive leaving. But let's just look at who this executive was. Highly praised, responsible for integrating. So you've got that problem. Now there's a bigger issue. So they said that they had a $225 million debt deal with this Torian Capital. Well, that thing never materialized. It was supposed to close, I think, August 31st, the first third of it, $75 million. And not only did it never close, they haven't said a word about it. So I think they've left their investors hanging, and I don't like that at all. And so I spent, this is important because I'm a big Houston Texans football fan, and I can only watch it with one eye because I spent my entire Sunday a couple weeks ago, good game, by the way, working on the 27 stocks that I follow the closest. I really think that this capital crunch we're in really mandates that all of us, especially me, spend more time making sure that these companies' finances are in order. And that was one of my takeaways that, I already told you I got rid of it after their last report. They went from making money to losing a lot. Gross margins plunged. And I took a look and, without that money coming in from Torian, they are in bad shape. Now, I think that, we'll see some recapitalizations. My subscribers are always saying, who's not going to make it? Who's not going to make it? They'll all make it. That's not the point. It's just what kind of capital are they going to take and at what price? And we've seen some very disappointing equity offerings, Kushco and Ianthus, for example. If you would have said at the beginning of the year that these financings would take place, people would have thought you were insane. But the environment's changed and these financings did indeed take place.
Sure. So it sounds to me like you're of the school of thought that thinks there's going to be some consolidation among these larger MSOs as the sort of weak get separated from the strong as a result of the tougher capital conditions.
I don't know that there'll be consolidation. It's very complicated because, for instance, let's say that you're an MSO with Florida operations and you want to merge with another one, you got to get rid of one in your Florida operations. They actually limit, and there's some other situations like that. Many of the MSOs have their footprints pretty well established too. So I don't know that the consolidation is not going to be what you were just talking about, which is these big guys getting together. I think you're going to have a separation of the winners and the losers. And, MedMen, I know, you and I have talked about that a lot, and I really admire what the company's done in terms of differentiation on their approach to retail and focus, whatever you want to say. They've done some good things, but they've done some horrible things. And to see the second CFO in a year depart in the circumstances surrounding that, and repricing of an equity offering, repricing of a convertible note they did with Gotham. So this is a company that I would say has huge problems, unfortunately. As much as I like them and wish Adam the best and his team that's left, if you're an investor, you really got to start looking more closely at these companies. And like I said, I called it gas in the tank, this review that I did. And you want to make sure that your MSOs have gas in the tank. And I'll share the easiest example. I'm not saying it's a buy. It may be, but TrueLeave has the most gas in the tank of any company I'm familiar with, either side of the border. They're generating huge operating profits, positive cash flow. They've got, it's not a fortress balance sheet like maybe Kronos or Canopy that have the strategic investment dollars that are dissipating, but they still have them. But it has a good balance sheet as well. So that's one that you shouldn't be worried about this capital crunch impacting. It may slow them down. And in fact, as we head into earnings season in about 3 weeks, 4 weeks, I think, actually, I'll be at the Benzinga conference next week in Chicago. A little plug there for anybody in the Chicago area that wants to check that out or wants to fly in. I think, we need to listen to these MSOs. The environment has changed. Capital is very difficult to raise. A lot of transactions were announced over the last 6 months that haven't closed yet. We already saw PharmaCann and MedMen in theirs. Will Verano and Harvest close? I doubt it. I think there's going to be some other ones. So I think it's incumbent upon all of us to ask these MSOs, not who they're going to consolidate with, because that's not what's happening, but how are you changing your behavior given what's going on in this current environment? And if they're not, then there's a problem. That's what I'm looking to learn, James.
Right. Wow. Well, it's great to talk to you again, Alan. You've always such a great original perspective. I really appreciate that. We're going to leave it there for now, and I will come back to you just as soon as is reasonable. Thank you very much for joining me today.
All right. Take care, James.
Only one, two, three.